Can we start with just a general breakdown of the Federal Reserve, like a light, what its functioning is and its role and how it affects the global economy? Then we'll go into the analysis.
Sure. So we could talk for hours on that question. Broadly speaking, the Fed is an independent central bank, and they have a dual function as given to them. One is to manage stable prices. The other is to manage the employment situation. And those are the two things which normally will move in parallel with one another. So, in other words, if you have a situation where you have significant tightness in labor supply and a very strong labor market, that might lead to price imbalances and rising prices, which is what we've been dealing with the last 18 months or so. Or conversely, the opposite, where you have a lot of slack in the labor market, or you have excess of aggregate supply and a lack of price pressures in the economy, and a need to manage your monetary policy. So what the Fed does with its dual mandate is they set the short-term interest rate, and they manage the reserves in availability essentially of credit in the banking system through this process. And the primary commercial banks relate to the Fed. And the Fed essentially manages and orchestrates, by setting the short-term rate, the overall context of interest rates in the U.S. and by proxy, given the role of the U.S. dollar in global affairs and trade, it has a significant impact on the rest of the world. Not only from a capital and credit position, but equally from a lot of countries that have their currencies, for example, tied to the U.S. dollar because of its stability. The hegemonic position the dollar has in terms of global trade, where the dollar is used as a medium of exchange between countries that may have nothing otherwise to do with the U.S. It's still part of this global economic matrix, and therefore what the Fed does is of primary importance. And the dollar and the U.S. economy, being the largest economy in the world, usually sets the pace and the trend, and so there is a knock-on effect throughout essentially global asset markets and everything else. So what the Fed does is super important, and it's not just the price of money, but it's also the supply of money that they also have an impact on. And both of
So
these,
when we talk about the supply, it's quantitative easing and quantitative
well,
tightening.
so that is a so yes, indirectly in some ways, because the quantitative easing is the expansion of their balance sheet. And when I talk about them influencing the supply of money in the marketplace, clearly the expansion or pace of credit expansion by the commercial banking sector, the Fed there are several levers the Fed has that impact that process. As it relates to the Fed's own balance sheet, and of course, in that, again, it could be a long conversation about mechanics of monetary policy and how this impacts through reserve requirements and other types of, for example, macroprudential tools the Fed has to which impacts banks' decisions on how they manage their balance sheets and everything else. As it relates to the expansion or contraction of the Fed's balance sheet. So that is something that was done following the credit crisis as a way to further create liquidity and easier financial conditions in the economy, because interest rates were already zero. So it was a way de facto to take real rates lower than zero if possible. And there's some hyperbole to that, but we won't get into that. But the reality is the quantitative easing effectively impacted the dollar rates outside of the short-term Fed funds rate in a causal way, because you have normally an upward sloping yield curve, which means short-term rates are lower, longer-term rates are higher. And that's a reflection of a few factors: inflation expectations, what's called term premium.
So